This JTS Mortgage Minute is brought to you by JTS & Company Mortgage Professionals.
Hey, good morning. I'm Jeff Farnham. Redfin recently conducted a survey of first-time homebuyers and asked them how they save the money for their down payments. They found that millennial homebuyers are increasingly purchasing the home the old-fashioned way, by saving directly from their paychecks. Unemployment is at its lowest point since 2000. Millennials have never worked in an economy this strong before and are now making enough from their paychecks to save for a home. The fact that they are less often relying on family members or sacrificing retirement savings to fund a home purchase is another sign that millennials are gaining their financial footing. Down payment, prepaid items, closing costs, and cash to close are all terms you hear when discussing a mortgage loan. The difference in these can be confusing for borrowers of all stages in life, not just first-time home buyers. Your down payment is determined mainly by the loan type you qualify for and can range from a minimum of 0% to 5% up to 20% depending on what makes sense for your long-term goals. This is your upfront portion of the purchase price and becomes your immediate equity in the home. For example, if the home cost you $200,000 and you put down 5% or $10,000, the initial loan amount will be $190,000. The difference between the loan balance and the home's value is the amount of equity you immediately have in the home. Prepaid items are payments made in advance of the monies due to obtain your new loan and usually include homeowner's insurance, property taxes, prepaid interest, and mortgage insurance if applicable. The homeowner's insurance premium and property taxes are often funded through what's known as an escrow account. An escrow account on behalf of the lender lowers the risk by making sure the home is protected against liens for missed taxes or insurance payments. Closing costs are the fees associated with taking out a mortgage. It is simply the cost of doing business. These are fees in addition to the sales price and include all the fees or charges for actions or items connected to originating and closing your mortgage loan. Payments to title companies, attorney fees, recording fees, appraisals, etc. are one-time charges associated with the closing of your mortgage. Cash to close, also known as funds to close, is the amount of money you need to bring to closing to complete your real estate transaction, which include your closing costs, any down payment, and prepaids from property taxes and homeowners insurance. This amount equals your purchase price and closing costs minus your mortgage amount, earnest money deposit, and any credits from the seller or mortgage lender. In most loan scenarios, the seller can pay the closing costs and prepaids, therefore minimizing your cost to close. If you want to purchase or refinance your home, give us a call today. We understand this can be confusing because there's so much information and moving parts to the transaction itself. Don't trust this process to a national 1-800 lender that you can't sit down with face-to-face. At JTS & Company, we've been making homeownership easy since 1996, and we want to help you become the next homeowner. We are local, trusted, and experienced, and we look forward to working with you. Thanks for joining me today, and be sure to tune in next week.
This JTS Mortgage Minute is brought to you by JTS & Company Mortgage Professionals.